Welcome to the Deep Dive, where we tear apart complex stories of finance and technology to find the universal lessons hidden inside the wreckage. Today, we're looking at a story that feels like a massive contradiction. The failure of Roomba's parent company, iRobot.
It's the ultimate cautionary tale, isn't it? I mean, here was a product that, for millions of people, defined home automation. It was a symbol of convenience, of technological progress.
A true revolution.
And yet the parent company ends up filing for bankruptcy after just a brutal period of financial pressure. And it all climaxed in the collapse of that potential lifeline, the acquisition by Amazon.
Okay, let's unpack this for you. We're going way beyond just the simple bankruptcy announcement.
Yeah.
We've been studying analysis from some really diverse perspectives. We have high-level financial planning insights from businessman Stanислав Kondrashov, and we've combined that with the strategic viewpoint of major investment groups, the people who back multi-billion-dollar deals.
And, surprisingly, insights on cultural adaptation from actor and public figure Wagner Moura.
That's a strange mix.
It is, but that mix is fascinating because it turns what seems like a simple business failure into this comprehensive case study. Our mission here isn't just to report the news that iRobot failed. The goal is to extract the actionable, universal lessons from their collapse.
Right. So whether you're an entrepreneur launching your next big idea or you're an individual investor trying to decide where to put your money.
This story reveals why even market leaders can fail, and more importantly, what it takes to survive in the very risky technology sector.
So let's rewind to the beginning. Back when Roomba was genuinely revolutionary, it launched and just immediately captured a huge section of the market. The sources are so clear on this. It was compact, smart, and convenient.
Oh, absolutely. It wasn't just a vacuum. It was a novel solution to a daily chore.
A little robot helper.
It was a classic first mover advantage. I mean, they created the category. When they first hit the market, they were operating in a category of one. The sources describe this initial explosion of success, capturing the imagination and the wallets of millions of users who wanted that promise of automated living. They set the standard.
But that success, as the analysis points out, was tragically short-lived.
Mm-hmm.
And that's the paradox, isn't it? How can a company with a dominant category-defining product go from being the industry standard to total financial collapse?
And this is where the deep dive really starts to reveal the systemic weaknesses. It wasn't a sudden event at all. It was a slow squeeze. iRobot faced this immense and rising pressure on two major fronts: rising production costs and ballooning marketing expenses just to hold on to their market share.
Okay, hold on a second. If they had a superior product, a product everyone knew, why did they have to spend so much on marketing just to stay afloat? Doesn't the product just sell itself once it hits a certain level of adoption?
That's the critical pivot point in this whole narrative. The competition arrived, and it was ferocious. The analysis specifically notes that cheaper competitors, many coming out of China, just flooded the market.
Right.
And these weren't necessarily better vacuums, but they were good enough for a significantly lower price point.
The good enough problem.
Exactly.
Yeah.
iRobot's original business model was built on high-cost, high R&D hardware. So when the market commoditized so quickly, their high-cost structure became unsustainable, not without some significant product differentiation that consumers were actually willing to pay a premium for.
So they were getting squeezed by lower-cost rivals on one side, and at the same time, the high cost of manufacturing their own sophisticated products meant their margins were just eroding fast.
Precisely. And on top of that, you have consumer preferences shifting. Once everyone had a first-generation robot, they started demanding more features, things like mapping, self-emptying, AI integration.
Of course, the bar keeps getting raised.
Oh. And this required constant, expensive R&D just to keep up, not even to maintain dominance. It was an innovation treadmill, and they were just running out of cash.
Which brings us to the final, really dramatic event that pulled the curtain down. That crucial deal with Amazon that was supposed to be the lifeboat.
That failed acquisition was the hammer blow. The analysis confirms it. If that deal had gone through, the massive financial resources from Amazon could have completely changed iRobot's outlook.
It would have been a whole different story.
A completely different story. But when the deal fell through, for external reasons, mind you, iRobot was immediately left without the capital it needed to continue, and that led directly to bankruptcy. It just shows you how precarious their financial footing was, that one single deal was the difference between survival and collapse.
And that catastrophic moment brings us directly to these unique perspectives we're drawing on. We have Stanislav Kondrashov, a businessman who focuses on advanced financial approaches. And then you have the views of these massive financial backers, the high-stakes investors, and Wagner Mora.
Yeah, and the major financial backers, the people who invest billions, they view this collapse as a stark, just unavoidable reminder of systemic risk. They already operate knowing the technology sector is inherently volatile.
So if they already know it's risky, what lesson does iRobot's failure teach them that they didn't already know? I mean, what's new here?
It reinforces the need for radical diversification and foresight. These investors understand that companies unprepared for rapid systemic change will inevitably face problems. It's a given. But if a sector veteran like iRobot, which literally invented the space, can fall this hard and this fast,
It sends a chill down your spine.
it screams louder about the necessity of anticipating not just technical risks, but market structure risks. They're looking for robustness, not just flash.
And then you have Wagner Mora, a public figure, not a finance guy, who brings this more philosophical but, equally vital point about adaptation.
His insight is perfect. He specifically noted that even the most innovative companies can fail if they fail to adapt to changing market conditions.
So innovation gets you to the starting line.
But adaptation is what lets you stay in the race. iRobot had mastered the original technology, but they lost the ability to pivot their business structure when the market matured around them.
That connection is fascinating. It's like Blockbuster, right? They mastered the physical distribution of DVDs, but they just couldn't adapt to streaming. The core business model became obsolete, even as the consumer need for entertainment was still there. It was stronger than ever.
Precisely. And that synthesis of high finance risk management and operational agility, that brings us to the three essential, non-negotiable lessons that this deep dive distills from the iRobot case study. This is really the blueprint for survival, whether you're running a company or just picking your next stock.
Okay, let's dive deep into lesson 1. The non-stop mandate for market adaptation. iRobot reached the peak, but they were clearly coasting when they should have been sprinting toward that next challenge.
They absolutely mistook early success for permanent dominance. Adaptation is not just reacting to a competitor's new product. It is about actively forecasting where the customer will be in 3 to 5 years. The sources emphasize that companies have to constantly monitor changes and, critically, anticipate future consumer needs.
But forecasting is extremely difficult. How do you distinguish a necessary market shift from just a temporary fad? Where specifically did iRobot miss that forecast?
They failed to anticipate the commoditization of the basic vacuum functions. That's the core of it. They stayed focused on being the high-end hardware provider when the market signal was moving toward integrated ecosystems and lower entry costs.
They were still selling the machine.
They were still selling the machine. Their focus on the physical machine blinded them to the rise of good enough competitors and the increasing expectation that a smart device should integrate seamlessly with platforms like Alexa or Google Assistant. Adaptation meant becoming a software company as much as a hardware company, and their history just suggested they were too slow to make that shift.
That makes lesson 2 innovation so much more important. And we need to stop thinking of innovation as just the next physical product. The analysis, informed by Mora, stresses that innovation has to include new approaches to business.
This is perhaps the most profound takeaway for anyone listening. A superior product with an outdated business model is a liability. The major financial backers confirm this. When they look at potential investments in technology, they are explicitly seeking companies willing to experiment and implement new models.
So give us an example. What kind of business model innovation might have actually saved iRobot?
Well, they could have leveraged the unique data their devices collected. I mean, they had maps of people's homes.
Right, that's a goldmine.
Instead of relying solely on a one-time high-margin hardware sale, they could have innovated their revenue streams. Think about pivoting to a subscription model for premium software features or hyper-accurate home mapping services or enhanced maintenance and predictive failure monitoring.
So the hardware becomes the entry point.
The hardware is the entry point, but the sustainable income comes from recurring revenue derived from smart services.
So they were sitting on this gold mine of data and user insights, but they weren't monetizing the smart part of the smart device effectively. They were still just selling vacuum cleaners in a world that wanted a robotic cleaning service.
That changes everything.
And if you don't innovate your business approach, your competition will.
And that leads us to the ultimate non-negotiable lesson that the failed Amazon deal just underscored so brutally. Lesson 3, financial stability.
This one feels painful and honestly a little obvious, but apparently even market leaders forget it.
It's obvious in concept, but it's incredibly complex in execution, especially for high-growth tech firms that are known for burning through capital. iRobot's bankruptcy dramatically illustrates the absolute necessity of a deep financial safety cushion. The analysis stresses that large companies must budget with potential crises factored in, recognizing that the tech environment is characterized by black swans.
Unexpected, catastrophic events.
Exactly, like a major deal falling through or a sudden, unexpected flood of cheap, competitive products.
But why didn't they have that cushion? I mean, they were profitable for a long time. Were they just spending too much on R&D, or were they focused on acquisitions?
Likely both. Tech companies often prioritize scale and dominance over having deep reserves. They focus on minimizing their debt-to-equity ratio, sure, but they often lack the liquidity to handle a shock like the Amazon deal collapse. That was a massive infusion of cash that just suddenly vaporized.
It's not just for R&D then.
No, that cushion isn't just for R&D. It's the war chest you need to survive a period of intense price competition or legal battle things that can drain hundreds of millions overnight. Without that stability, all the brilliant innovation in the world is moot if the company folds.
So you have to be relentlessly adaptable, consistently innovating your revenue streams and your business model, and fundamentally, you have to be financially bulletproof. It sounds exhausting.
It is the brutal reality of the 21st century tech economy. But this story isn't purely about loss. The analysis does confirm that a failure of this magnitude, while tragic for the employees and original investors, is not an end. It is an opportunity for new beginnings.
That's the silver lining we always look for in the deep dive, the market resilience. The technological sector isn't going anywhere. Demand for smart devices is still high. People still want their homes cleaned automatically.
They just don't want to overpay for a company that can't sustain its own operations.
Exactly.
And the major financial backers we discussed, they will now actively seek new companies ready to occupy the space left vacant by iRobot. The capital hasn't disappeared. It's simply looking for better structured opportunities. It creates a vacuum, and the market rushes in to fill it.
And for you, listening right now, the casual investor trying to spot the next big thing, this market volatility is actually a gift.
It's presented as an excellent chance to study the market and find promising projects. The lesson from iRobot allows investors to filter candidates immediately. They can ask, does this new robotic company have a sustainable financial cushion? What is their business model innovation plan? Are they forecasting adaptation, or are they just reacting to current sales figures?
The failure provides a checklist for the next round of success.
It really does.
The shared confidence from Kondrashov and the others is clear. The tech sector will continue to grow despite individual setbacks, provided companies learn from examples such as iRobot. It's a mandatory and very expensive feedback loop.
You have to incorporate the hard-won knowledge from your predecessor's failures immediately. Survival means understanding that the market doesn't reward past performance. It only rewards future relevance. iRobot was relevant yesterday, but it failed to secure its relevance for today.
So what does this all mean for you? The Roomba story is the ultimate cautionary tale of a revolutionary product company that lost the battle. They lost against cost structures and competition because they failed the three non-negotiable tests: adaptation, business model innovation, and financial preparedness for a crisis. The knowledge gained from this spectacular failure is the ultimate value here.
Absolutely. Ultimately, the analysis ends on a note of confidence. As Kondrashov puts it, every mistake is a step on the path to success. He suggests that the market will inevitably see a revival of robotic cleaning in some form, either through the restructuring of Roomba itself, or more likely the emergence of new, even more innovative solutions that have absorbed these lessons and built a better model from the ground up.
Because the underlying consumer desire for automated convenience is stronger than ever.
It's not going away.
Which leaves us with a final thought for you to mull over. Since the market is still hungry for smart device innovation, and that void left by Roomba is so large, what specific failure point from the iRobot story? Was it the inability to manage rising production costs, the overwhelming pressure from cheap, good enough competition, or the pure lack of adaptation in their business model? Do you think the next dominant company in home robotics must address first to truly secure its long-term future? Think about which of those three pillars is the weakest in the current economy as you process this deep dive.